Hi, welcome. Thanks for watching and I appreciate you being here. Today's video is about the market crash. I wanted to talk about why I'm actually happy that the market is crashing this year. In this video, I'm going to discuss what the market has done this year, the impact of the correction on my portfolio, and the reasons why I am celebrating the dip anyway. Towards the end, I'm also going to discuss what I hope will be the outcome of the market decline overall for us as an economy and as a society. And I'm going to provide some resources if you're interested in reading further into any of the things that I mentioned today. But before I start, here is a little bit about me. Hi, welcome to my channel and I'm glad to have you here. Here's a little bit about my family. Our household consists of myself, my husband, and my toddler. My mom also lives with us, but she's not included in our finances. My husband and I both went to graduate school, but we no longer have student loan debt, fortunately. I work in banking and he works in aviation. I handle all of the family's finances and I love my role as the self-appointed CFO. I love talking about all things money, making money, saving money, investing money, and optimizing my portfolio and my finances in general. I look forward to taking you on a wealth building journey with us. I hope you enjoyed the videos and the channel as a whole, and I look forward to getting to know you. I am very open, so feel free to send me messages at any time or starting conversations in the comment section below. As of the time that I'm recording this video, here's what the market is doing. The S&P 500 is down more than 2.75%. The NASDAQ is down more than 3%, and the Dow is down almost 2.5%. If we take the S&P 500 and use it as a measure for the market, this year the market is down more than 17% year to date. And the impact on my portfolio has not been good, just like everybody else. Honestly, it feels like I'm throwing money into the void. My balances are lower today than they were in January, even though I am contributing several times throughout the month. My husband and I were both W-2 employees and we both have access to 401ks. We get paid every 2 weeks and we actually get paid on alternate pay days. That means every week, one person is putting money in a 401k account. We also put money once a month into his Roth IRA, as well as a 529 for our son and money into a brokerage account when we decided that we were going to start saving diligently. For context, we are maxing out both the 401k and the Roth IRA. If you're keeping track, that's approximately 4 different account types with at least 6 to 7 contributions per month. And honestly, it also stings extra hard due to the fact that I lump sum my own IRA contributions at the beginning of the year, the first chance that I got in January, which we now know was essentially the top of the market for this year so far. So you're wondering, how can you be happy about this? Let me tell you what actually inspired this video. I found this post on Reddit that says, "Hi, my past 2 years of income are positive. This year is negative. Will lenders care? I trade stocks for a living and the stock market has crashed, causing negative income this year." And then right below that paragraph, they list their 3 years of income. In 2020, income $21,000. In 2021, income $110,000. In 2022, income year to date is negative $40,000. This is somebody who is trying to determine if they can afford a mortgage based on their income. If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good, and of course subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. Okay, so what is it that I am happy about? This person, not to make fun of them at all, that is not my intention, but they are the prototype of the people that I'm thinking of when I make this list. First, this bull run has given people a false sense of security, encouraging them to take on more risk than they should. I don't know how many posts that I saw when the market was going up of people asking whether or not they should invest their emergency fund, whether they should go into a higher stock allocation, and a stock allocation that really truly does not fit their risk tolerance or their risk profile, and people who are increasingly interested in using margin. Another reason is that everybody is a genius in a bull market. Most people, if not everybody, is making more money to some extent. That has elevated the profiles of people who really got lucky rather than people who are necessarily skilled or know what they're doing. And these people now have undeserved credibility to encourage bad behavior or for them to promote scams. For example, the rise of really bad financial advice on TikTok, a medium where the videos are extremely short and you can only fit so much information in there. I am going to include a link in the description box below where this financial advisor spent some time following TikTok influencers to see the kind of advice that they were giving, and he found it to be pretty bad, which is exactly what I would have expected. But when everyone can make money, everyone looks like a genius, even if they are really completely unskilled and they're just lucky. Also, there's the constant emergence of new fads that are solely designed to separate you from your money. Things like junk coins like Shiba Inu, Dogecoin, and things like NFTs, which give me major tulip mania and Beanie Baby energy. When the market is going up, 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 inhibitions are gone. People lose their inhibitions, which makes them more susceptible to fraud, especially from trusted influencers. Last year, Kim Kardashian, Floyd Mayweather, and a couple of other celebrities were sued for some crypto pump and dump schemes. There are scammers in every type of market condition, but they thrive in bull markets. Scammers will either feed on your fear or they will feed on your greed. But when you are fearful, you are more cautious because you're trying to keep food on the table, you're trying to keep a roof over your head. On the other hand, if we find ourselves in an economic expansion, we have more disposable income to get scammed out of in the first place. And not only are there new fads that are designed to separate you from your money, but there are also old tricks in the book that might have been dormant because people were more cautious, but that re-emerged with the bull market and the irrational exuberance that follows. I'm talking about things like penny stocks and complex investment strategies that are beyond people's abilities to understand and their abilities to take that risk. In the summer of 2020, a 20-year-old Robinhood trader committed suicide after an option trade went bad, and he thought that he owed the trading platform over $700,000. Subsequently, his family filed suit. Fortunately, not everybody is getting margin called to the tune of more than $500,000, but even if this is an isolated incident, this is still a very tragic case. And just because people aren't necessarily killing themselves, it doesn't mean that they're not ruining their lives in other ways. They might potentially be destroying their relationships, they might be wiping out their life savings. Death is pretty bad and it can be the worst thing that happens to you, but it is not the only bad thing that can happen to you. And speaking of Robinhood, the rise of platforms like Robinhood encouraged the gamification of trading. Sure, in some ways, Robinhood isn't all bad because it democratized investing for the regular people, but at the same time, user interfaces that are designed to seem very familiar and hip are designed that way on purpose. They are meant to keep you on the platform longer and encourage a lot of activity. The digital engagement practices, like seeing confetti when you execute a trade or notifications that pop up in ways that look like text messages, mentally disconnect you from the fact that you're dealing with real money. And number 6 is that people are able to misrepresent their income sources. They are claiming that they're making money on the market doing these risky trades, investing in these weird penny stocks, investing in these joint cryptocurrencies, but most of them are making money of content creation. Content creation is a primary source of income for them, but the claim that they're making money in these alternative investments or these scams, that claim ends up being believable because you see a rally, so then suddenly it is not as suspicious that somebody might be making money that way. If they get paid to promote an investment, or if they talk about an investment just for the purpose of driving traffic, you may not even realize that they are not invested in these things. You are less skeptical about the veracity of the claims that they're making. And finally, last but not least, the biggest reason why I'm happy and celebrating this market crash is because I am in the accumulation stage. That is one of the stages of your financial life that allows you to buy stock at a discount. Everybody under 45, or I would even go as far as saying that people who are under 50, if they started investing a long time ago, should be happy about this opportunity to buy more. Just the other day, a friend asked me if she should reduce her 401k contributions in light light of the volatility in the market and given the fact that we are really approaching correction territory, I told her that she should keep everything the same, and in order to explain it to her, I gave her a soup analogy. Let me share that with you. If you use $10 to buy soup at $2 a can, you get 5 cans. A week later, you go back to the store, you see that soup cans are 50% off. Now your $10 can buy you 10 cans of soup. If your goal is to only get 5 cans of soup, you drop your budget to $5. That makes sense, right? But what if your goal is to get as many cans as possible? Why would you make any changes? If your goal is to get as many cans as possible and your budget is $10, you should be happy every time you see a sale, because when it's 50% off, that means your $10 can now get you 10 cans. Market corrections and crashes bother everybody, but if your investment horizon is long enough, it hurts less if you learn to reframe your thinking. And here's how I reframe my thinking when it comes to the equities market going down. I look at my investments in terms of shares rather than stock price. Rather than saying, look at my balances, they're shrinking and that makes me sad, I say, oh wow, I can buy even more shares with this amount of money that I'm putting in every couple of weeks. So what do I hope is going to be the outcome of this market crash? I hope that younger millennials and Gen Z will understand that this kind of bull run is not normal, and they really should not be making long-term plans on these huge outsized returns. I am a millennial, but I am on the older end of the millennial spectrum. I remember very well when the dot-com bubble happened because I was in high school and I had just graduated college when the great financial crisis happened. I have a different perspective, and I know that these bull runs are not normal and that these returns are not routine. I also hope that it ends the belief that investing should be exciting, because I feel like when people think that investing should be exciting, that really blurs the line with gambling. They take on more risk than they should without realizing that the excitement of making a lot of money goes hand in hand with the trepidation that you might lose a lot of it as well. I also hope that it ends the trend of people taking risky advice from unqualified people, or even maybe well-meaning people who don't necessarily have a full picture of your life. In my case, I make these videos, and a lot of these videos, I do spend my time talking about what my family is doing with our personal finances. None of the things that I say should be taken as financial advice, because your life doesn't mirror exactly what my life is doing. Even the most qualified person cannot fully give you advice unless they know what you have going on. The information that they give you, even if it is technically accurate, does not necessarily mean that it applies to you. It is merely a snapshot that you can use to do additional research and build on to see if it fits into your life. When people see nothing but the market going up, they really feel less inhibition and they feel much more comfortable listening to just anybody and everybody. And finally, I hope that it gives people a true idea of what their risk tolerance is. I feel like a lot of people overestimated their ability to handle risk. So many people these days are saying, should I sell? Should I just sit on cash until there's a rally? Some people are saying that they are losing sleep. I have already shared what the market is doing to my portfolio. It is not a positive impact. My balances are shrinking, but I can tell you that I sleep well at night, and that is because I have not taken on more risk than I should have. I didn't invest my emergency fund. I am not trading on margin. I am not trading options that are expiring worthless. I do have a margin account. As a matter of fact, I recorded myself applying for margin on Merrill Edge just as a demonstration in order to have something to put on the channel. Zero intention of using the margin because I am not interested in getting margin called when the whole thing drops. Is my portfolio doing better than anybody else's? Not necessarily. Well, I guess if you're invested in ARK, I'm probably doing much better than you. But to the average investor, I'm not doing much better than them. But I only took as much risk as I could handle because I knew that the party was going to end at some point. With that said, here is some of the stuff that I talked about today. There is an article here on people taking TikTok financial advice. Kim Kardashian, Floyd Mayweather was sued in a crypto pump and dump case. I'm gonna post that link in the description box below. And there is the Robinhood trader who committed suicide. That is such a tragic incident. There is an article here on the gamification of trading. You can follow the link and you'll be able to follow the SEC report on platforms like Robinhood that really make people forget that this is real money in real life that they're dealing with. And before you go, how do you feel about the turbulence in the markets right now? Does it bother you? If it does, tell me why. If it doesn't bother you, share some tips on how you keep things in perspective to stay calm. And what do you think about my reasons for being happy that the market is going down? Are they valid or am I being cynical? If you can think of any other reasons why this particular dip or even any other occasional market crash is good, please be sure to share in the comment section below or feel free to make a video response. I look forward to hearing from you and I will see you in the next one. I would like to continue sharing my thoughts on all things money with you. So I would appreciate it if you could help out the channel by liking this video and sharing it with anyone you think might benefit from it. If you want to see more content, be sure to subscribe and hit that notification bell so you can know when new videos come out. I'll see you in the next one.